This is the Landlord Survival Show. When people stop being nice and shit gets real. You're the landlord. We're here to help. This is a show for what the gurus don't tell you about owning rentals. We're here for you because we're stronger together.
Brought to you by Empire Industries Property Management. Built for investors, by investors.
Hey everyone, welcome to the Landlord Survival Show. This is your host, Steve Rosenberg, and I am the owner and co-founder of Empire Industries, property management company and realty services. And first and foremost, I am an investor. I own properties. People that know our story and they know about Pete and myself, they know that we started as investors buying properties. And one of the biggest challenges we had was when we were trying to learn how to create wealth and learn how to buy real estate was that everybody teaches you the front end about buying properties. I guess they teach you the front end if it helps them. They don't always teach you all the information, but they do it if it helps them. And nobody really teaches you the true reason why you want to own real estate, which to me is the wealth building, right? Building the wealth. I mean, anyone can get a deal. Building the wealth and learning how to do this over long periods of time, not only for you, but for your family and for your kids and passing it down is, to me, really the key. And so we created this group. It's on Facebook, the Landlord Survival Group on Facebook, as well as this podcast show, the Landlord Survival Show, which also is on iTunes and Google Play. And we created this show so that investors that have questions, investors that want to know how to be better at what they do, more than just the skill of getting a good deal, can help you. And so we have people like my good friend Chris, who I'll introduce in a second of what he does. We have people like Chris on the show because they have a vast amount of knowledge. And Chris, like myself, we do this because we want to help people. We don't get paid to be here on this show. We're not getting a salary to do this. We're doing this because we want to help investors be better at being investors. And I don't think that there's a playbook out there that really explains that well. And so we created like I said, the Facebook group. We've got our website, selfmanagemyproperty.com. We have a lot of free information on there. And again, I think that there's a lacking out there in the industry for people that want to learn to be wealthy and just don't know how to do it. So I've got my good friend, Chris Picciurro on. Chris, thanks for coming, man. I appreciate you showing up today, buddy. I know after the holiday weekend's got to be tough.
Oh, you know what? It was great. I had a wonderful weekend. It's hot here. I'm surprised you'd let a Tennessee Titan fan on your show.
I didn't see you sneak that one in, man.
I know I didn't show it to you before, so. But no, we're having a great time, and happy Memorial Day. Obviously, you know, we think about all of our veterans, think about all the people that fought for our country, our freedoms, including my father, who's a Vietnam vet. My grandfather, who's a World War II veteran, and my uncle, just a ton of service people in our family, and we try to remember them on every day. So sure. First of all, thank you, and to the families also.
Sure. Absolutely. And that's a good thing to talk about because, you know, people, you know, they obviously fight for our country and they do what they do. And similar, you know, you're teaching people how to remember you and wealth, right? So tell everyone kind of what you do and, you know, what your specialty is, because you do a lot of things actually that people would be very impressed with. But just kind of give everyone your resume of that and kind of how we met and how long we've known you for.
Great. Well, first of all, I have truly enjoyed working with yourself and your team. We met, gosh, it's got to be 6 years ago or so.
It's been a while.
Through NARPM, the National Association of Residential Property Managers. Our firm, which I'll get into in a second, but our firm provides continuing education opportunities for NARPM and for the National Association of Realtors. And we do a lot of work with non-resident investors that buy investment property in the United States, and also with domestic investors.
Sure.
And I'm the co-founder of a company called Integrated Financial Group, and what we do is we partner with clients to make healthy financial decisions for them and their family. So there's a wide array of things we can do, but that's our marching orders, if you will.
Yeah. Yeah. And so, you know, what I think a lot of people don't realize is, and I didn't know the in-depth of this, but, you know, when you're trying to build wealth, again, just buying a rental property or creating a company doesn't ensure that you're going to keep that wealth with you, and not just for you, but for your family, and then maybe to have it as a legacy. And, I think what you do is, some people say like, oh, do you have a tax guy? I'm like, I got a guy that does my taxes, but that's not all that he does. It's like, that's a piece of a very big puzzle, right? And how do you, when you're talking to an investor, whether they're new or experienced, young or old, how do you explain how important your piece actually is for people in the creation and the retaining of wealth?
Well, that's a great point. And we say, in our organization, leadership is a team sport, and really your investment portfolio and your running in treating it like a business is a team sport. That includes your acquisition team, your getting the right financing, the management of the property or the assets, and the professionals that you use. The CPA being a huge part of that. And also maybe working with a financial advisor that understands that real estate, you want real estate to be an asset class that you invest heavily in. So for us, once we really figure out what someone's situation is, the tax return preparation is not really the real value. The value is in advising, consulting, projections, and running tax projections and being there to help people make decisions. Similar, if you're an investor, think about when you sell a property. When you sell a property, that's just a transaction based on the fair market value at that time. It's just recording of an event. That's what a tax return is. The important part is the planning side. And again, a lot of planning can get done before the end of the year, and not that much planning could get done after the end of the year. So what we do is, in our ecosystem, my role is to run the tax side of our practice. I love real estate, and that's one of the 2 to 3 niches that I really focus my practice on. And a lot of times CPAs ask me, hey, how can I grow my practice? How you guys? And I said, well, here's what you have to do: find something you have a passion for, and go practice in that arena.
Go deep.
So if you like woodworking, then join the Woodworkers Association and start talking to woodworkers about taxes and stuff. So
no, it's true. It's true. And I mean, you gotta be focused, and you gotta enjoy what you're doing, or at least have a very healthy knowledge of what you're doing to be able to pass that on. So let me ask you this: if you're talking to someone who's brand new at investing, right? They come to you and say, I don't even think I need you, which I know a lot of people I talk to, they go, I'm not ready for that yet. I need that. That's down the road. But the reality is when someone gets involved in investing, that's actually when they need to start thinking about that, because, like when I speak on investing and I talk about creating wealth, it's like you start with the end and you work backwards. Right? And so do you kind of educate people along those same lines, or do you have a different tact when you're talking to someone about you're getting started in investing and, start with the end, or how do you do that?
Right. Well, my dad's not on Facebook, so I can talk well about him and not let him get a big head, but he always says, if you don't have a plan, you have a plan to fail. So, so the thing is I would agree, think about, so what we do in our practice is that we offer a complimentary initial consultation. It's 30 minutes, and doesn't mean at 31 minutes I'm going to hang up. We look at your prior year tax return, and we do a needs assessment. There's a lot of times I talk to people and I say, hey, you're doing great. You give them some pointers, let them walk away saying that was worth my time. And if they're at a point where they should engage a CPA, then that's great. If they're not at that point, then that's okay too. I think if you, in our business, we love helping people out. And in general, people don't care how much you know until they know how much you care. And I love the initial meetings, because I just like to get to know people. We like going to events. We do, we went to one of your events, an investor showcase. I shouldn't say showcase, but an investor education event. Yeah. And that's where I learn. I learn a lot from our clients. And the cool thing is, I also help prepare all their tax returns, myself and our team. So I can see what markets they're investing, what might work for them, and that tips me off as to what tools we can use. In the tax world, in general, bigger picture, the government creates tax laws to attempt to influence our behavior. So the tax rules that are out there right now, especially under tax reform, is extremely pro-investor. There are a lot of things out there right now that you can use to reduce, eliminate, or defer payment of tax using real estate. And once you understand that, then you can get going. And even people that, sometimes we run into folks that have a significant amount of assets, but maybe they don't have a lot of cash. Maybe they're in their retirement accounts. And a lot of times we have questions about, hey, does a Roth conversion make sense? Should I use a self-directed IRA to start doing some deals, some hard money lending? So we're there to bounce things off of. So back to what we do is we do that initial consultation. And then if we think a client is a good fit for us and we feel confident that we're adding a lot of value, we'll put together a professional services quote. And now over the last few years, I'm going to give your buddy Pete he's helped me out with give me some good tips on developing a subscription-based model. And that's pretty much exclusively what we have now. And the clients like it, because what we don't want is our client wondering, if I call this person, if I email them, if I set up a meeting, how much is that going to cost me? Because then they're putting a value. Like, one of our core principles is people pay us for our knowledge, not our time. And sometimes our knowledge is our network. I have clients that, let's say they're interested in investing in Houston or in Texas. I'm going to definitely have them talk to you folks, so.
Now, let me ask you this. When you're talking to an investor, right, and you obviously everyone's different, right? Everybody's situation is different. Everyone's lifestyle is different. Everyone's goals are different. So when you talk to someone and maybe they come in and they say, hey, I want to flip properties. I live in Los Angeles. I want to flip these $1 million houses. Mm-hmm. And, you start looking at their financial, you kind of lay all the pieces of the Legos out on the table and you look at that and go, you know what? Probably not a smart move for you. Do you kind of advise them? I know it's probably a touchy thing to tell them to do or not to do something, but do you kind of guide them if that's what they're asking you for? Or how do you handle that as far as what track to go down with this person?
No, we definitely, if they're a prospective client, we're going to give them as much advice as they ask for. If they're a client, I'm happy to give my opinion, especially if they ask for it. I have a real life example. We went out to an event in a market where half of the people there were from California, and they were interested in setting up a series LLC, which is a great option in Texas. But in California, every sub LLC you set up is an $800 per. So and I'm not an attorney, but I'm gonna guide them in the right direction and say, you might want to think about this. Or if you're flipping houses in California, since the tax rate's so high, even just to get started, would you consider living there for 2 years and maybe you qualify under the Section 121 exclusion and do it tax-free? What type of entity should you be, and that sort of stuff. So absolutely. And it depends. Like, once you see someone, I love the Lego example, because once you see someone's tax return, you automatically start seeing opportunity. It's like, okay, sometimes we're trying to create income, believe it or not. Sometimes I have a more mature age client that's a $200,000 capital loss carry forward, meaning they're going to write that off over $30,000 or $3,000 a year. They're never going to live long enough to write off that entire amount. So maybe there's some capital gains somewhere that they can recognize. So you're constantly trying to either accelerate deductions, maybe using cost segregation studies or using bonus depreciation, or sometimes you're deferring it using 1031 exchanges or qualified opportunity zone funds. So anyway, those are just some of the tools that we bring to the investor's attention, and we also vet out different people that we partner up with to make sure those things happen.
So let me ask you this, Chris. Obviously you like real estate. Obviously I like real estate. Why from a wealth building, from a tax perspective, from all those, why would you kind of stand your ground and battle to say real estate? I'm bullish on real estate. I like real estate. Why do you like it? What are your reasons and your rationale, and why do you kind of not guide people, but advise that may be a path to go down?
Right. So the reason I think real estate, well, first of all, our tax code tells us the real estate is favored. is a favorable investment. Now, am I out there telling people what market to buy in? No, that is not what I do. I will always defer to the local experts and advisors and some people have their own personal underwriting. I will absolutely run tax projections. So we just did it. So let's say you have a portfolio. Hey, I'm thinking about buying this portfolio. What does my tax situation look like? Should I finance it? Should I use cash? Should I use my home equity line of credit? Those things I can help out with, at least putting numbers to these questions, but I'm not going to tell you, hey, go invest in Little Rock and not Dallas. Like that's not,
Right.
I don't, but
over encompass.
Overall, so yes. So why do I love real estate? So first of all, think about your personal, if you are a homeowner, if you stay in your property for 2 out of 5 years and you never rent it out, you can sell your property and walk away with up to $500,000 if you're married filing jointly, $500,000 gain, not sales price, but gain, tax free. And you don't even have to buy a new property in a new market or another replacement property. That right there is what the Shangri-La of our tax code. So you might say, well, why is that in there? Well, what is the term for a House of Representatives person? 2 years, right?
Right.
What a coincidence. They go buy a house in DC, they go do their 2 years. They're allowed to sell it, go back to their home state and pay no tax. So we should take advantage of those things. The depreciation deduction, in many countries, they don't have a depreciation deduction. So I would say, taking a step back, the 3 best things about real estate would be your Section 121 exclusion, which is your the primary residence, the ability to deduct your property. Like for a residential property, if you buy it for $100,000, you're given approximately a $4,000 per year deduction, even if you bought it for cash. And a lot of people get confused about depreciation because they think, well, my property is going up in value. And they're right, but they still get to deduct the price they pay.
That's even better. Like that's even more of the reason.
Exactly. And so they get to deduct the depreciation, and they could potentially now with tax reform accelerate the depreciation, this is like, I've got a sweet talk you enough to get me on another show if we could talk about some really advanced strategies 2.0, but maybe they segregate out the cost and accelerate that depreciation.
Yeah, cost segregation, that's huge to be able to start getting into that nitty gritty, yeah.
Yeah, and that's a great tool. Now, if you depreciate the property and sell it in the future, you will have to add that back to your income. So cost segregation studies aren't perfect for everyone, but let's table that for a second. The third best thing is the step up in cost basis. And people say, well, what does that mean? Well, that means this is the Shangri-La again. Let's say you bought a rental for $100,000. Let's say you lived 20 years and you deducted $80,000 of it over your lifetime, just numbers off the top of my head. And now that rental's worth $200,000. If you pass away and your beneficiaries inherit that property, they get a step up to the $200,000 of value. And if they start renting it out, they get to start deducting it over $200 with the $200,000 number. Or if they sell it, they don't pay much tax on it.
Right.
And that's where I see the biggest opportunity for clients and practitioners. But when I talk to practitioners, is if you have a married couple that filed jointly, has rental property that one of the spouses passed away, you at least have a 50%, if there was titled jointly, you at least have a 50% step up in basis. Because think about it, if it's a husband and wife and they own a property together and one passes away, the surviving spouse gets to step up the value for that 50% of the property.
And the thing is too, is, with all of everything that you're talking about, the one thing that, again, one of the biggest pieces, which is for wealth building, not tax advantages, but wealth building, is the appreciation factor. The fact that this property, whether there's nothing I can do right or wrong that is going to stop that property from going up in value. So when you talk about building wealth, you buy, my son, he was 14 years old. He bought his first rental property. What will that property be worth? Let's say he buys 5 of them. He wants to buy 5 before he graduates high school. Will he? I don't know. But let's say he buys 3 of them and he's 18 years old and he has these properties. What are those worth down the road? Not counting depreciation and all that, just for building wealth and being able to transfer that down. I mean, that, again, going back to the strategy, it's the tax advantages, in my opinion, you may not, like you said, you may not buy a property based just on the depreciating ability that you have, but it's a piece of the puzzle that you have to take into account. You got to take that into consideration into the math computation as to why you would and wouldn't buy it. I mean, it's going to happen, but again, how many people don't take advantage of it correctly? And you look at that and you're going, man, what are you doing? Like, you're not being an educated investor. You're just buying a house. Like, that's not the key to wealth, in my opinion.
Oh, absolutely. And then sometimes I'll run into clients or potential clients that say, well, I didn't depreciate my property because I didn't want to, because I don't know if you depreciate it or not and you sell it, you have to add that back in your income. So sometimes, we run into client situations where someone did not take the depreciation for 5 years. Right. Now there's a remedy to it, where you would have to file a special form with the IRS, and basically you get it to recap. You get to take all that depreciation you should have taken in one lump sum in the next year. But we don't want to get too technical and start losing watchers.
So let me ask you this, Chris. So the last time we spoke, which when I had you on my radio show, so that tells you when the last time. I know you've been down and we had you at our owner education series and stuff, but we were talking about the new administration coming in, and you were saying that things were going to be changing because of the new administration. Has that happened? And is that, I know we were talking earlier saying that it's very advantageous. Is it very pro real estate now? Because, we hear all the news and all this stuff, but you actually know what the laws are changing and how that's happening. What are you seeing on that regard?
Great question. So yes, tax reform it's been the biggest change to our tax code since 1986. So I actually had a hairdo then, and my Detroit Tigers were good. That's how long ago it was. And the Astros probably weren't. No. But so now you got Verlander and everyone's happy over there. But anyway, no, it's been a huge change. There has been a lot of things that have spawned from tax reform in the real estate world. From a tax perspective, what's happened is the concept of bonus depreciation is now out there and available on property that has a 20-year asset life or less. So someone might say, okay, please let's speak English again. What that means is that, let's say you have a property. In general, a residential property, you're going to have to depreciate it over 27.5 years, commercial 39.5. But there are personal property components to that, such as windows, doorknobs, electrical, siding. The list goes on and on. Well, those asset classes now, instead of if you can identify them as like a 5, a 7, or 15-year asset class, they can be immediately deductible the first year.
Yeah, because I remember when we owned an apartment complex, there was a lot of that cost segregation where, driveway, parking structure, parking lot, what I mean, is you slice that thing up. I mean, I remember it was pretty complicated as far as getting all that stuff done. So that's, I could definitely see that being a huge, huge benefit. Now, let me ask you this, the flip side of that. Are there things going on in the administration or trends or economy that kind of makes you have a little bit of fear, where you're kind of going, okay, this may not be good. If I'm an investor, I need to keep an eye on this. If I own real estate, I maybe want to accelerate this. Are you seeing stuff on the negative side that potentially could be popping?
Well, the theory in general is that one in the hand's better than two in the bush. And meaning that most investors want a return of their cash as quickly as possible. Right. That's why accelerating the deductions is typically a good thing. Just coming back to tax reform, the qualified opportunity zones, those are new. That's where you can basically put any capital gain, similar to a 1031 exchange, but any capital gain into a new project. They work similar to REITs, and you're deferring your tax until 2027. So I guess the fear is, hey, if I take all these deductions now, our country's in debt. Aren't tax rates going to be higher like 10, 15 years down the road? And do I want to save those deductions till that time? And that's really the flip side of not taking them today. But you have to also then weigh, one, I could get hit by a beer truck tomorrow. Two, I could, yes, but if I factor in the time value of money and my money working for me and turning it over a couple of times in that time, I've built more wealth. So it really comes down to the investor, and most of our clients are in their peak earning years. So or they're kind of pre-retiree looking for a more a passive income. So back to the cost segregation studies, if you buy a property wholesale and then you run your own rehab, as long as you segregate out and keep track of the costs, you can have your own cost segregation study. You don't need to have it done by a
Does it depend on the size? Does it depend on the size? Like I know some people that have, several hundred unit apartment complexes. Mm-hmm. Does that start getting a little bit more or assets? What if you have assets in different parts of the country with, does that start getting a little complicated though? I mean, if I have stuff all over.
No, that's a great question, because what you have to factor in are different states.
Right.
So for in the state of Tennessee, if you own a property, just an example, in an LLC, we have a franchise and excise tax, and the state of Tennessee adds back your bonus depreciation when calculating your tax, but not what's called Section 179. So it really depends. Now in the state of Tennessee, because I don't want you 10 CPAs if they are listening to this start blasting me on, but because there is something called a fonts exemption. So if you have an LLC that only owns rental property, you can avoid, or you can elect out of filing the franchise and excise tax. But yeah, so state considerations are huge.
And just to be clear, you're in 9 states, is that right? You're in multiple states, aren't you?
Yeah, so we have physical offices in Michigan, here in Tennessee, in Florida, and in South Carolina. But we have clients that last counted over 40 states, because we really focus on, in our ecosystem, are going to be entrepreneurs, small business owners, real estate professionals, and highly taxed households. So
let me ask you this: who is the client that would call you? Like who do you say, man, that is the person that I can help the best, that I can go further? Where are they in that cycle of evolution of being an investor or a business owner? Because I mean, that's how we met you, owning property management company. Who is your client that you go, that's the person I can help the best?
Mm-hmm. Well, we always say, let your best client pick your next client. So typically it's going to be a referral from a client that we play nice with, which we pretty much play nice with all of them. But no, it's going to be someone that is very entrepreneurial minded, that either, if they've already started their business, that's all right. But a lot of times they've outgrown their current provider. Right. Either it would be themselves, or maybe a local CPA that really doesn't know real estate that well. They've done a good job helping specializing in owning real estate and kind of getting the most juice out of that, right? Correct. And once you maybe they've had their taxes prepared, but the professional really can't explain it, and it's kind of like you don't really know something until you teach it. That's why we love doing the NARPM, the realtor education events, and because if I put on there like, hey, I'm going to do tax reform 2.0 deep dive, then I have to not just read my accounting journals. I have to come up with some case studies. I have to dive into it. So now, let me ask you this. So going back to my first question, that was people that are your best clients right now are the ones that you go after. So you get a lot. I know you get a lot of referrals, because I know we refer a lot of people to you, and we'll talk about the specialty that you do in a minute with out of country investors. But it sounds like people kind of, that are in the heat of battle, owning properties, buying, selling, having a business, just the people that are entrepreneurs, maybe not the ones that are exiting or the ones that are in the initial, but it sounds like in the middle of that bell curve. Is that a safe statement? Yes, I would say if someone feels like they've outgrown their current provider, then we would probably be a good fit. And again, it could be a self-provider. I did have one more thing on tax reform. Yeah. The biggest opportunity in tax reform is something called the Section 199A deduction. And so as an example, if you're listening to this and you have a CPA that you're working with, and you are they're not aware of the 199A deduction, then you should probably think about looking for another provider, because this is huge. What that is it provides up to a 20% additional federal deduction based on your business income. Now, there are some limitations, and a lot of our clients that have rental properties actually have losses from the rental properties because we're deducting mortgage interest, property taxes, and depreciation. But some of them do have profit from the rental properties, and they could they may be eligible for the Section 199A deduction. Just as recently as January 18th, only reason I know that is because of my birthday, but January 18th, the IRS came out and came up with some, what we call safe harbor elections to make sure that if you have rental properties and you have a profit, what do you have to do to qualify for this additional deduction? But the 199A deduction is huge. So that tells us this administration, and this isn't a political show, but this administration is very much pro-business, pro-entrepreneur, and is attempting to reduce the tax that self-employed people are paying, with the theory that these people will reinvest in their business, invest in real estate. So
it's so from what I hear you saying is if you're going to own real estate or be an entrepreneur, this is probably one of the better times that you and I probably know of to be able to do that from the political climate and from what the advantages that they give you. It sounds like you're kind of saying like, look, if you're going to do it, right? And this is the time because you're afforded the most benefits because of it. Now, let me ask you this. So for the people that do get into it and jump in head first, what are you seeing some of the top mistakes that investors are making, business owners are making when it comes to not only taxes, but building wealth? And like how do you see you've got to see a common trend. You've got to see just shit that they do that you're like, man, I can't believe he's doing that. Like that was stupid. Like maybe don't say stupid, but that's what you're thinking in the back of your mind. Like that was not smart for you to start your business that way or go down this path. What do you see as the common thread?
Well, I would say people that buy property without an end game of it. So the end game might be, I'm going to keep this property as a legacy. It's going to produce a lot of income. It might not be in an A or B neighborhood but that's okay if that's their strategy. So sometimes people just buy things to buy things because they like shopping, and then they don't really have a plan. I would say another concerning thing would be someone that centralizes all of their properties, and it doesn't diversify, not just with real estate, but with neighborhood type of property and demographic area. So, I have clients that really like it, but there's also synergy when you're talking about property management trust. So what I've seen our most successful clients do is they'll find a market they love, get to the point and scale it till they have about 10 properties, and then find another market and do the same thing. Another mistake is not arranging their personal finances to be what we call quote unquote bankable. And I think World War III is going to be the CPA community and the bank underwriters. We're going to take out our pencils and stab each other because we have completely different motivations. But I'm very cognizant before I prepare a tax return, and I probably told this to you, like, hey, are you looking to refinance? Because there are a lot of cool things in the tax code right now that allow deductions for real estate owners. There's something called the de minimis safe harbor rule, which basically says anything you buy $2,500 or less, you can automatically deduct. So think about a washer, dryer. Well, my motivation is to deduct it as quickly as possible. But right. I know an underwriter is going to see repairs and maintenance and ding you on that. Right. So set it up for depreciation and take the bonus depreciation on it. It's still the same end result for you, even though it's a pain in the butt. Like, why are we depreciating something that's worth for $900 when we could just deduct it? Because I know what the add backs are going to be.
And so that does that go back to not knowing the end goal of the strategy of why, because if you're saying, hey, if I'm going to buy this and then I'm going to sell it down the road and buy more, and all of a sudden you're doing the wrong strategy, you can go, man, you screwed that up. You can't buy anything because of what you did, because of how you showed this property, or you can't refi it because of the way that you strategize that. Is that kind of what you're saying?
Yes, absolutely. You should have a strategy. You should partner with a lender that you're not just worried about rate. You need a lending partner. You need someone that you can talk to and figure out, understand what the rules are, how many loans you could have under Freddie and Fannie, what they're looking for. A lot of people start so small, and from what I've seen, just on my side of it, is it's harder to get a loan for $60,000 than $600,000. It's easier to get it's easier to actually get $1 million loan on a fourplex than a $60,000 loan on a little house.
That's true. That is so true, man.
And it makes sense though, because there might not be market diversification from that lender. So finding your lending partner is huge, and making sure the lending partner and your CPA, we can communicate about things and figuring out what your strategy is. And I would say, the other thing I see with is, if I, as an investor, don't create your own underwriting. Don't rely on a bank to tell you what something's worth, you have to figure out what your goals and objectives are and come up with a price. And don't get deterred if you write 20 offers and you get 20 accepted, you're probably offering too much. So that's just from what I've seen. And that's the great part about my job, is I learn so much from our clients, and it's a blast.
Yeah. Now let's talk about I don't want to say the last thing that you do, but one of the things that you do that's vital for us is you work with out-of-country investors. So, with us, I would say 50 to 60% of our clients are either out of state or out of country. Mm-hmm. And so we get a lot of investors, obviously, from out of country that want to own in Texas. And there's obviously laws that sometimes they don't realize, even if they're paying cash for a property, there's laws that go along with owning real estate. And so your firm comes in and helps them with facilitating that, so that they're staying within the confines of the law. Is that basically in a nutshell?
Absolutely. So we have a niche where we help non-U.S. residents, tax residents. Now, our tax code calls them aliens. We don't like to use that term. Technically we call them foreign nationals. When they buy investment property here, and a lot of the laws changed about 18 months ago when it comes down to them owning a single member LLCs. But we won't get into the weeds too much there. But what we do is we help them with their tax planning and compliance. Because if they are a foreign national buying a property here in the United States, they're going to be subject to what we call FIRPTA tax withholding. And we can avoid that FIRPTA tax withholding with the right compliance forms. So we have to identify you or your entity as the owner. We have to file a certain form, the IRS forms, with your property manager, so that you aren't subject to all of that withholding. And then on the flip side, when a foreign national sells property, there's typically tax withholding, and most of it is returned to the investor. But we have to file the right forms.
I mean, I know that when we get a client, and we get a lot of them, I know first thing we do is send them to you until you kind of give us the blessing that, they're good to go. We don't really want to go down that path, because we want to make sure that they're in compliant with the laws. And, they don't know that. And a lot of, property management companies or investors, they don't understand that you can own real estate, obviously, in this country if you're not from here, but there's laws that you have to comply with. And there's a lot of paperwork that you want to make sure that you're doing correctly, because, we all know that when you get that letter that says you messed up, it's not a nice letter, and it's not just giving you a warning. It's normally a, hey, there's action being taken against you or your company or whatever. And, that's not a path that we want to go down. And we don't want our clients to have to go down that path, because they're paying us to be the experts. And so, again, we're not the expert in the taxes, but we've got one. And, it works great for us. And I know you help a lot of our clients, and I know a lot of NARPM property management companies use you too. But that's vital. Let me ask you this, with the current administration and everything, are you seeing an uptick or a downtick in that field of business that you're in?
Well, I think that in general, there's more selling than buying from foreign nationals right now. Mm-hmm. I think that the IRS is, in my opinion, is taking the approach of doing more correspondence audits and penalties for not filing. So for instance, if you own a property and you get audited, your tax return gets audited, well, the IRS could examine you and say, well, okay, property management fees, those are deductible. We don't know about this. You went to Orlando to look at properties, but we found pictures on Facebook of you at Disney World, so we're going to throw that out. But still, that's a cumbersome task for the IRS. They're very much understaffed. But it's much easier for the IRS to say, you have a single member LLC. The rules changed 18 months ago, where that LLC now has to identify itself and file a a corporate tax return, and it's a $10,000 penalty. And here you go. So that's really where it comes down to when we onboard the clients and talk to them and figure out what their compliance requirements are. And they've changed a lot. And it's from the property management perspective, just because, if someone owns a property in an LLC, that just tells us that the LLC owns it. Depending on how many owners the LLC has it made a corporate tax election, what country the owners are from, that'll dictate the compliance forms that need to be in place. So there's and especially Canadians, I know, maybe not tons in Texas, but I know our clients in Arizona and especially in South Florida and in parts of the Gulf side of Florida, the Canadian government does not recognize an LLC as a transparent entity. So we see, unfortunately, Canadian clients form LLCs, and it's kind of a hot mess that we have to work through. But
now let me ask you this. I was just talking to someone that I know, and he does the apartment syndication. And so he was saying, basically, my understanding is that you can basically be from Canada, create a U.S. LLC, and I may be paraphrasing this, so it's not exact, but basically you can do an LLC in the U.S., partner with another LLC of the syndicator. So your LLC is a partner with their LLC, and you're good to go. Is that not exactly the case anymore, or is that, very roughly, of course, but
right. So in the U.S., you can do that. The issue becomes the Canadian Revenue Agency does not recognize a U.S. LLC as a transparent entity, meaning they consider the LLC a corporation. The beautiful thing about the United States tax treaties, so pretty much most of the countries we play nice with, you avoid double taxation. So that if you pay U.S. tax, then in someone's home country, they get a credit for that. It's the same thing for us. If we, Steve, if you have a property, or if you have a mutual fund that paid a small tax to Canada, or let's say you own a Canadian stock that pays you Canadian tax, and there was tax withholding and paid to the Canadian Revenue Agency, you get a credit for that on the U.S. return. Well, like I said, the CRA, Canadian Revenue Agency, that LLC would have to either elect to be taxed as a corporation to avoid double taxation, or probably what's happening is they're forming a an LLP, limited liability partnership. And that's probably what they're going to, they'll figure out the structure.
So yeah, because I know that a lot of people from Canada are looking to do that, and they've asked me about on the residential side, and I'm like, that's a Chris question. I'm like, I don't know the answer to that, because that gets a little deeper, because I know they want to do it in the syndication with the apartments, which obviously is a little bit more of a complex situation, but I don't know how it's handled on their side, on the Canadian side. And that's what I tell people. I'm like, we can help you on this side, but I don't know exactly what happens on your side when you try to pull that money back into your country, if it's Australia, China, whatever the case may be. And, that, again, that's why I just send them to you, because I don't want to give them advice on taxes. I don't want to tell them, definitely don't want to steer them in the wrong direction. Definitely don't want to be held liable for steering them in the right direction that could cost them fines and IRS and everything associated with that. So yeah, it definitely. But
yeah, a lot of our Canadian clients do what we call a two-tier structure, where they have a Canadian corporation own a domestic U.S. corp. And the reason you'd want to do, and then the domestic U.S. corp would then enter into the syndication. One of the reasons you would want to do that is that a domestic U.S. corp is not subject to FIRPTA. Because if you have a syndication, and in your syndication, so Steve, let's say you're managing the property and there's a syndication, you can give the 1099 to that syndication. That's all that you have to worry about.
Right. But
the syndication entity then might have FIRPTA withholding if it has non-U.S. resident or foreign nationals as owners. So now that FIRPTA withholding pushes on to the syndication. So if the Canadian has an LLC, I know it gets really technical, that elects to be taxed as a corp, and that corp's owned by a Canadian corp, then you could probably avoid the FIRPTA withholding, because the withholding for foreign nationals is 30% of your gross rent. So and although they can get that back in a tax refund, that's really hindering your cash flow, especially if you have a mortgage. You don't even have enough cash to pay.
Yeah, absolutely. Absolutely. Well, Chris, man, I always learn so much from you. And I know this was 1.0 in your mind. It was 5.0 for me. But if somebody wants to get a hold of you and they want to talk to you, what's the best way for them to do that?
Right. Well, we would, if you're listening to this awesome show, and I'm going to download it on iTunes, my next run, and then I'm going to have a mental list of all the things I screwed up on. But
Yeah.
no, please go to www.realestatecpa.guru. That's realestatecpa.guru. If you just put your information in, we'll give you a complimentary and confidential initial consultation. I'm going to guide you in the right direction, and myself and our team will, we'll talk to you, look at your tax return, give you some great ideas, and if we're a great fit for each other, then we'll move forward. But it's a great first date for all of us.
Yeah, and full disclosure, I do use Chris for my taxes. Our Empire uses them. We refer all our clients to him. I use them for my personal rentals as far as the wealth building. So I mean, I've got firsthand knowledge. Great, very respectable firm, and again, it's nice to have someone that has all this knowledge of that. So I definitely, I don't think people even realize how much knowledge you have and your depth of your team, because your team is awesome. I mean, I personally deal with them for my properties and my wealth, and it's great having the ability to, if you're, again, I'm not just talking to you about something, I'm talking to a specialist in your team about a certain question that I may have, and it goes on and on. It's not just, hey, Chris, now put on your real estate hat, now put on your business hat, now put on this hat. It's like, I've got a person for that, I got a person for that, which is great.
Well, thank you. We're trying, we want to build something that goes beyond my career, my business partner's career. And I think that's another issue, is we want to develop our next generation of leaders in our organization. Because if a client's entering a relationship, I hope it's the last time they have to find a CPA firm, and we want to be their firm as long as they need us. So obviously there has to be a transition plan into professional development. So I really appreciate that. I also appreciate the opportunity to be on the show today. And when we're ready to talk about something else, maybe towards year end, I'm happy to have a chat.
Yeah. And like I said, give Chris a call. And Chris, they can find you on Facebook as well, right? What's the name on Facebook if they want to find you or your company?
It would be Integrated Financial Group, and or on Twitter, it's PICC, P-I-C-C, CPA.
And don't hold it against him because he's living in Tennessee now. So we'll hold that against you there. But hey, Chris, thanks again for being on the show. And if you want to go to our Facebook group, Landlord Survival Group on Facebook, website is selfmanagemyproperty.com. And of course, you can go to our podcast show, the Landlord Survival Show. Chris, thanks again, buddy. Appreciate it. Everybody, we'll see you next time. Thank you very much.
Thank you.
Chris.
Have a great one.
Bye-bye.
This has been the Landlord Survival Show. Join us next time for more of what the gurus don't tell you about owning rentals. And for even more, find us on Facebook.
Brought to you by Empire Industries Property Management. Built for investors, by investors. For more information about this show, visit our website, selfmanagemyproperty.com, home of the ultimate landlord survival handbook.